Pepkor has returned to profitability. The owner of Ackermans has rung up an annual profit of 2 billion rand. That's from a previous loss of 1.2 billion rand. The swing is as a result of growth in the group's retail and financial technology segments. Looking ahead, Pepkor plans to open as many as 300 new stores in 2025. That's as it expects consumer spending power to improve as food prices ease and electricity supply stabilizes. Life Healthcare has decided to dish out a healthy payout to shareholders. The private hospital operator has declared a final dividend of 31 cents. That's an increase of close to 15%. And the firm has also announced the payment of a special dividend of 70 cents per share. This, along with other payouts during the year, means that Life Healthcare has returned 10.6 billion rand to investors in 2024. That's largely as a result of the sale of Alliance Medical Group. Looking at the group's performance during the year, revenue rose 12.7% thanks to robust activity growth in Southern Africa, while headline earnings per share from continuing operations jumped 59%. Zeda has achieved record revenue. For the year to end September, the car rental, leasing and sales group posted a 14.5% rise in revenue to 10.4 billion rand. The firm puts the acceleration down to a strong performance by its leasing business, but the top-line growth failed to filter through to the bottom line. Operating profit fell 5.6%, with the operating profit margin declining to 14%. That's as the group had to maneuver in a challenging used car market. A final dividend of 50 cents per share has been declared. This takes the total payout for the year to 100 cents. Subdued trading has weighed on Cal Group. The firm formerly known as Carp Agri has posted a 3% decline in annual revenue and a 9% drop in headline earnings per share. The agriculture, fuel and manufacturing company says despite this, it will still reward shareholders.
Even although our revenue pulled back a bit, we believe it was mainly once-off items in the year that put pressure on our consumers and our retailers buying from us. We still generated 860 million EBITDA for the year. Our debt levels are the lowest in 10 years. We've been able to quite easily pay off 206 million in interest-bearing debt, and therefore felt it would just be fair on shareholders to equal the previous year's dividend payment.
Vukile Property Fund is confident that it will meet guidance. That's after a good first half. For the 6 months to end September, revenue rose 5.8%, while profit ticked up 6%. An interim dividend of 55 cents has been declared. That reflects an increase of 6%. Stefanuti Stocks is back in the black. The construction group has posted interim headline earnings per share of 13 cents. That's from a loss of 22 cents previously. The firm says this is due to increased activity and a better operational performance. Stefanuti Stocks has been technically insolvent since 2021. At the halfway mark, its total liabilities exceeded its total assets by 94 million rand. But the company says it remains commercially solvent based on the cash flow projections stated in its restructuring plan, and thanks to the support the business receives from its lenders. Shares in Mass Real Estate have jumped. The counter closed over 6% at the end of the day. That's after the group announced that it has entered into negotiations with Prime Capital regarding the acquisition of Prime Capital's 60% interest in PKM Development. If concluded successfully, the acquisition would effectively terminate the development joint venture arrangements between Mass and Prime Capital and gives Mass full ownership and control of the assets, which include Carolina Mall and Mall Moldova. The talks are expected to wrap up by the end of the year, and further announcements will then be made. Further afield, Walmart has announced that it will no longer use race and gender as factors to promote diversity when selecting suppliers for contracts. Instead, the company will focus on merit-based criteria, and suppliers will not be required to provide demographic information to be eligible for financing opportunities. Here's more detail in this package report.
Walmart plans to cut back some of its diversity, equity and inclusion initiatives. A spokesperson for the retailer made the announcement Monday. Bloomberg reported Walmart will no longer consider race and gender to boost diversity when granting supplier contracts. It further said eligibility for financing will not be assessed based on suppliers providing certain demographic data. The report added Walmart will scale back racial equity training. It will also stop participating in rankings by an LGBTQ advocacy group and review its support for Pride and other events. A spokesperson for Walmart confirmed Bloomberg's report. They said they are willing to change alongside their associates and customers who represent all of America. The retail giant joins a growing list of firms feeling pressure from conservative groups. Other US majors like Starbucks, JP Morgan Chase and Ford have modified their DEI policies over the last year. Walmart's move follows a post on X from conservative activist Robbie Starbuck. He disclosed the DEI policy changes at Walmart before the Bloomberg report. Starbuck has examined and confronted companies over their employment policies. The Financial Times said Ford and Harley-Davidson are among companies that have said they would end some diversity policies after being targeted by Starbucks.
And all imports from Mexico and Canada have received a 25% tariff hiking pledge from the newly elected US President Donald Trump, and an additional 10% tariff on goods from China, citing illegal immigration and the trade of illicit drugs. Here's more detail in this report.
U.S. President-elect Donald Trump on Monday pledged a 25% tariff on all products from Mexico and Canada from his first day in office. Trump said on social media the tariffs would remain in place until the two countries clamp down on drugs, particularly fentanyl, and migrants crossing the border illegally. The threatened new tariff would appear to violate the terms of the U.S.-Mexico-Canada Agreement on Trade, which took effect in 2020 after Trump signed it into law. That deal continued the largely duty-free trade between the three countries. The president-elect also accused China of not taking strong enough action to stop the flow of illicit drugs crossing the border into the U.S. from Mexico. He said his government would impose an additional 10% tariff on goods from the country as a result. Trump has previously pledged to end China's most favored nation trading status and slap tariffs on Chinese imports in excess of 60%, much higher than those imposed during his first term. In response, the Chinese embassy in Washington said, quote, "No one will win a trade war or a tariff war." Mexico described the current trade deal as a, quote, "framework for certainty for investors," and there was no immediate comment from Canada. Economists say that Trump's overall tariff plans would push U.S. import duty rates back up to 1930s-era levels, stoke inflation, collapse U.S.-China trade, draw retaliation, and drastically reorder supply chains. They say tariffs are paid by the companies that import the products subject to the duties, and they either pass on the cost to consumers or accept lower profits. Trump frequently refers to countries paying as a consequence of his tariff plan, saying on Monday that Mexico and Canada will, quote, "pay a very big price." In 2023, the U.S. accounted for 75% or more of the two countries' exports.